Good morning. This morning I wanted to talk about inflation and not talk about the doom and the gloom or what's going on as far as what's going bad, but simply looking at what the inflation rates have been for assets and what that could tell us about the future of inflation, which will help to drive the Fed's purchasing rates on quantitative easing and on interest rates. And so let's get right into it real quick. Um, so if you look at an asset such as a house, people are buying houses to live in them. They're buying them not based on the rental value. They're not basing them on the future price increases. They're generally buying them to live in the house. And based on that, the price they can buy it for is determined by how much money they can qualify for to meet the payments. And so it can be wage increases that increase house prices. It can be interest rate decreases that increase house prices. Anything that allows someone to qualify for more money up front to buy what they live in. Now, when they do qualify for that, they generally will do now a fixed rate mortgage. And that sets them in at a certain interest rate for 15 to 30 years. So then if the interest rate goes up, what does that do? Well, it makes it harder for them to move to the same size house. And it also, helps them build wealth in that house because the asset values go up. So let's look back and say from 2020 to today, I looked at 3 different houses, different areas, and looked at the interest rate or the increase in the asset values. And so I got a 62% increase in a higher demand area, and in 2 lower demand areas, a 37.5% and a 57% increase. Now, that is driven by either wages or it is driven by interest rates. Okay, and so in this case, it is driven by interest rates and the availability of money, which correlates to inflation and the demand side. And so the average is 52.7%. So if we just say the federal government printed money in the rate of 60%, and that 60% translated directly to house prices increasing by 52% on average. Okay, then we can see that other assets that are not directly or not quickly correlated to that money availability, money printing, how they might be affected in the future. So, for instance, rent prices. Rent prices are on 1-year contracts. So generally what drives rent prices is either a new contract, which has a year waiting period, and a new renter, or increases in things like property taxes and insurance. Now, I looked at property taxes and insurance. They're up about 10%. So that would have triggered a 10% increase in rent from that direction. And I can tell you for new renters that prices are up about 40%. For existing renters, they're probably up by about 10%. And so you don't generally take a good renter who's paying on time and say, I'm going to give you the entire 40% increase. I'm going to give you, an 8% or a 10% or something related to your direct costs, because I have to raise rates with my direct costs or I'm not in a business. So my direct cost increases were like 10% on taxes. I pushed that out to all existing renters, existing contracts, but new contracts are probably 30 to 40% higher than existing contracts. There's a big disparity there. Food costs according to price indexes are up 16%. So if food costs are up 16% and housing costs are up 52%, you've got another 30-40% built in of increase just based on inflation. Okay, now this 30 to 40% that hasn't hit, this is what the Fed is working on with the interest rates. They're working on taking money out of the system, which is directly reflected into stock prices, and trying to combat this additional 34% to 40% that should be happening in food prices. Okay, and that's basically what's happening. Now, understanding that, what does that mean? Well, this asset class, if money comes out of the system, might be affected. Now, I will tell you that a person with a 30-year mortgage at a fixed low rate is probably not going to sell their house at a discount. Right? They're either going to try to rent it out or keep that mortgage, or sell it at regular price. And so this is not going to see the same decrease in price that the stock market sees. The stock market is very volatile, based on asset values that are out there. But when you look at commercial properties are directly correlated to cap rates, which are rent rates. And so they're going to depend on what happens with these lease rates from restaurants and from businesses and sales businesses, and how much they can pay from a rent standpoint. And so that is yet to be seen, because commercial rates are up from 3.85% now to 5.5%, and if the Fed keeps going, they could rise as high as 14%. That's going to triple the interest rate costs of that asset, for the landlord to hold it, and he's going to have to pass that along to tenants or go under. And so how is that going to affect values of commercial properties? Commercial properties are going to change quickly based on the interest rate. Now, some of the contracts on commercial properties are 3 or 5 years with extensions in there, and so that's going to stabilize some of those price fluctuations for the renter, but not for the landlord. And so I think there's going to be some difficulties there that can be taken advantage of. And so I just wanted to kind of take some time to explain it to you. This is really what the Fed is targeting, this 34% increase in food prices. How do we decrease that? And can it be done with interest rates? How can they affect gas prices to decrease those numbers? But that is what they're targeting. And targeting that, as seen in the previous video, is having this effect of the stock market going down. So if they have to continue to raise interest rates to combat that, you could see another 30%, maybe 50% decrease in the stock market. How am I acting with that? Number one, I am shifting out of some crypto assets. Number two, I'm holding cash, waiting for some of the hysteria to hit the market, because when people start to understand that the stock market could decrease another 50%, they're gonna freak out. They're not used to this. Most of this generation has never seen that, and that's going to create a great spike down in the prices that is going to reflect some of their belief changing and some of the emotion in the market. And that's what I'm looking to maybe buy some, is when that emotion starts to get priced into the market somewhat. Now, do I think that once it spikes down and comes up, it won't go down more? No, that's going to be based on the Fed rate. But I do look to buy pieces of companies that I want to own during this time period. And so that's still what I'm going to do. And increase profits on businesses. I'm still investing in different assets, different sales things to sell. And so I just wanted to share with you what the Fed rate was trying to combat, the truth, what the actual inflation had been, which is this 52.7% in the asset prices of houses, and then what historically we've seen as these Fed rate increases, go on. If they really pump it up to a 10% increase, you could see a 70% decrease in the stock market value, as we saw from 65 to 74. Now, do I think that they will? I don't know. I have planned for a risk of another 4.5% increase in my actual commercial loan rates. and so that would put us at about a 5.5% Fed rate. So that is what I'm planning for right now, as far as what I need to do, to be prepared for that, and then what I have left to be able to invest at that point. Just wanted to share this with you, for what you think about is going on. Still would encourage you to dollar cost average, because, if the Fed determines that we're not going to do this, or maybe the oil prices drop dramatically and impact inflation, then that could still trigger the stock market growth over the long term. I'll talk to y'all later, and bye.